who went from meals to bills. It's eat what you kill when you're in the field. And the pipeline overflowing, I don't drip, I spill.
We don't seek balance, nah, we want extraordinary. If you really knew my dreams, every morning's scary. We got more to spare, ain't no shortage, baby. Winning by the chopper and another for my lady.
Talking about the bird in the strap, say the word and she handle that.
Fully loaded, put it at the target, and you know we letting off every man. Got money, who got my back? You can never get it if you never ask.
Big bags, legendary swag. Only one thing better than cash.
When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow.
When I walk through, no I won't do, no I won't do, no I'm talking to, not to, you know about to do, what? Walk in that door.
Sorry, I had to stop my bootleg music. Jerry, you got control of the screen there?
All righty, give me just a second.
Hello, everybody. Yep, we can see you.
All right, can you see my screen?
Yes.
All right, great. Well, cool.
All right, I'll go ahead and start here. Give me 1 second. All right, hello, everyone. Happy Wednesday. Welcome to the Multifamily Freedom Chasers Financing Zoom. My name is Shelly Miles. I am a commercial mortgage broker and a co-founder of Adventure Commercial Capital, together with Mr. Jerry Miles, which I will bring up here in a minute. Thank you all for being here. What we do is we connect real estate investors to lenders, real estate investors that want to buy multifamily, fix and flip, storage units, hotels, any business that has real estate attached to it, because each investor is unique and each deal is unique, and we have the skills to connect you to the right lender. We are like a one-stop shop. Also, I wanted to remind you guys that this platform you can use it to connect with each other. It's not just educational. You can use it to connect with each other. So I encourage you to put your information in the chat and put your name in the chat so we can get familiar with you. Yeah, and that's it. And then our next slide. So today's agenda is going to be, we're going to introduce the ecosystem, and then we're going to introduce who we are as a family, and then Jerry's going to talk about the current debt market update. It's very important to know that when you're underwriting deals. And then we're going to go into our main topic, which is what is the biggest challenge facing commercial real estate, and then we'll have a section for a Q&A. There's also going to be a section where you can introduce yourself. Sorry, I said introduction, who we are. I meant who you are. All right, go ahead, take it away.
All righty. So first, if any of you guys are brand new to a Freedom Chaser Zoom call, let us know in the chat. Put a 1 in the chat if you're brand new. And I can't see the chat, so you'll have to tell me. But this is the Freedom Chasers community here. We do Zoom calls every week, Sunday to Wednesday. Sundays we do the activation Zooms with Trevor and Victor, and we usually have a celebrity guest on there. Mondays we have alternating calls now with asset managers, BB and Iffy, and then we do broker talks with Peter and Ed on alternating Monday nights at 8 p.m. Tuesdays, we have napkin underwriting with Will, Aldo, and Ed. And then tonight you have us with the debt Zoom, and we alternate with Andrea and Drew and Avishkar, who are on here. They actually do theirs at 8:30 on their Wednesdays. So that's the only one that isn't at 8 p.m. So
Yeah.
This community, guys, we have spent $40,000 on mentorship programs, on one mentorship program in particular. And I believe that the information in this community for free is as good or better than the stuff that they were giving us in that other community. So take advantage of it, connect with other like-minded individuals, and come in and be a part and learn all you can.
Yeah, I just went ahead and threw the Facebook group in the chat. You can click on that link and you'll have access to all these events. You'll have reminders. We'll bug you all the time. I know I bug people all the time, but no, there's a couple new people, Kenneth Jackson and Trina Page. Sorry, my bad. The first timers here. Welcome, guys. And then we have some regular faces we see all the time, like Andrea.
Thank you. For sure. Welcome, guys.
Yep.
All right. And so who are the Miles? That is me and my wife, Shelly. One of our sons is on here right now, JJ, and the other one is Jordan. We are commercial mortgage brokers and the founders of Adventure Commercial Capital. We lend on commercial real estate nationwide. We got started in this business. We saw a need, for somebody in our area. Our local area here is the Cincinnati area. We saw a need for a broker that could bring these products to the marketplace in a fair and honest way. We have been investors for about 10 years ourselves, and have had some brokers doing the same job we are now in the same business that were taking advantage of us. And through that process, we actually found a school that trains you and teaches you and puts you in business as a commercial lending broker. We went through that school about 4 years ago. The school taught us all different facets of commercial lending, from equipment and, business acquisitions, the whole 9 yards. But we have, our heart is real estate. And so that's what we focus on in our business here. And that's what we lend on. So we'd love to help. It comes back to the Zig Ziglar quote. If anybody knows who Zig Ziglar is, if you help enough people get what they want, in return, you will get what you want. And so if we help enough real estate investors to be able to grow their portfolios with our lending products, it's going to, in return, our business is going to grow and promote us and our family as well. So that's why we're here and why we do what we do. So, and this is your chance. If you'd like to introduce yourself to the crowd, to the group, to us, we'd like you to go ahead and raise your digital hand, and we'll call you up and let you introduce yourself to us. Tell us where you're from, a little bit about your real estate experience, and those types of things. So, and I see Trevor here already. Go ahead, Trevor.
It's been a while since I've raised my hand for a Freedom Chaser Zoom.
Yeah.
What's going on, y'all? For those that are new here, Kenneth and was it Trina? I'm Trevor, one of the co-founders of the community, but without people like Jerry and Shelly and JJ, the Pillar Miles family, the community would not have survived up until this point. So somebody had to start it, but there needed to be pillars along the way to uphold and reinforce the community to make it what it is today. So appreciate you guys. And I guess I have a personal ask. If anybody is looking to get into an investment opportunity before the year's end, I would like to have a conversation with you. Of course, that's on our business side, which is Freedom Chasers Capital. The community side is the Multifamily Freedom Chasers. But if you want to have a conversation about potential opportunities, I would love to have that. You can hit me on Instagram, which is on my my name here on Zoom, or you can just hit me with the message in the chat.
You're muted, Jerry. Thank you so much, Trevor.
Of course. Thank y'all.
Yeah, thanks, Trevor, and appreciate the kind words. And you guys take Trevor up on that. Connect with Trevor. He's a rock star, and like he said, he's one of the founders of the community here. And can't say enough about him. Him and Victor and Marcel that were part of the founding group there. All great people, great guys. So definitely want to know them if you're wanting to be real estate investing and a part of the community here. So
yes, absolutely. And guys, throw your Instagram handle in the chat as well. Trevor reminded me of that. Connect with him and connect with each other. Also, JJ is going to be throwing ours in the chat.
all right. And I see Stephen Love with his hand up. Go ahead, Stephen.
Good evening, everyone. So you actually nailed it. I can't tell you how many people actually call me Stefan on a daily basis.
Oh.
But my name is Stephen Love. I am with the Joso Group, and it's a vertical real estate development firm, which is my specialty. I am a developer at heart, but in this past year, I have kind of dove off into the investment management space with a really particular vertical that we're trying out as far as a business plan right now. We're working a double simultaneous deal to where if this works out, then I think it'll be a pretty good deal. And I think it's something that we can repeat across a couple markets across the United States. As far as background, prior to real estate, spent just short of 18 years in the Marine Corps. And outside of that, not really much. I'm kind of new to the real estate game in regards to most. We've been doing it about 5 years now. And I'm always looking to learn, connect with people, and be the best asset that I could be for other people. And I agree with that comment you made, Jerry, from Zig Ziglar. And I really, really believe in it. Teamwork, team efforts, always help other people. And in return, you're going to be able to be helped as well. So I'm here for anybody that needs me. And that's me.
Awesome. Well, good to meet you there, Stephen. And yeah, make sure you throw your information and things in the chat. What part of the country are you in?
Tampa, Florida.
Tampa. Okay, great. All right. Kenneth.
Hey, thank you very much. Good evening, everybody. Kenneth Jackson. I'm here in San Antonio, Texas, home of the Spurs. And I've really actually been subscribed to this group for quite a while. I don't think that I have ever really sat down and hopped on a call. So I'm glad I did tonight. Yeah. I'm a human resources professional. Been doing it for about 30 years, 35 years or so. Multiple industries, tech, aerospace, healthcare, financial software, all that kind of good stuff. But for me, I sort of got interested in this whole real estate thing, residential, multifamily residential thing when my son invited me to a seminar that another group was having here at San Antonio back in the March timeframe. Spent a lot of money on it, haven't done much with it. I wish I'd known about you. So my wife, I wish I knew about you guys before I did all that. But just looking to do something different. Don't particularly own any real estate per se, but looking to do something on the development side. My family owns some property, and property in a growing part of San Antonio. If you know anything about San Antonio, the Alamo Hemisphere and things of that nature, the Spurs, which is part of the biggest attraction, is looking to move their stadium downtown. And my family owns some property on that whole line. And the reason they're doing it is because where the current stadium exists, there's not a lot of entertainment. So folks getting out of games like to go to entertainment and out drinking and eating and things of that nature. So moving to this part of town, that will be an opportunity to be within 1 mile of that dome. And I just happened to see my family's owned that property for over 60 years, almost 70 years. And I just happened to see that the a piece of property that we've been waiting to purchase has come up for sale along with other pieces. So it represented really a great opportunity for us to do something just in terms of commercial space, in terms of adding apartments, things of that nature on the building. So I'm just trying to kicking around that idea, and I was doing that tonight, and just happened to go to my email and saw the invitation here, and I said, "Wow, maybe
Nice.
that's a good thing." But I'm so glad I did. So all the topics that are on the agenda are things that I'd like to know about anyway. So just glad to be here tonight.
Awesome. Well, good to have you here, Kenneth.
You
I
bet.
appreciate everybody stepping up and introducing yourself. Right here, this is our contact info. This is my personal cell phone, mine and Shelly's email addresses, and then if you scan that QR code, it will take you to my hi hello. That one's my hi hello card, right?
Yes,
Yeah. Okay.
sorry.
And so that'll have all of my personal information on there. So
And I just wanted to say something that Kenneth said. He talked about putting some money down on a real estate group that he, like he said, paid a lot of money for, and he wished he had known about this group before. We are free, guys. Please let everybody know about us. We are free. We have a lot of education in this community that we can share with everybody for free. So
and
spread the word.
that's right. And you know, when the community is free, the community is not spending money to advertise and let everybody know they're here. So some of these other groups, I mean, that are charging 20 to 40,000 a pop for people to come and join them, they can spend 5,000 a person to get them to come in the door, right? This community's free, word of mouth, get it out there, share with people who we are and what we're all about here. So I'll put this contact info up here again at the end of the call if anybody didn't get a chance, but take a picture of it, screenshot, whatever, write it down. But we'll go ahead and get on into the current debt market update. Where are current rates and those types of things. The federal funds rate right now, the Fed just had a meeting last week and decided to hold the rates where they were. So right now we're still at that 5.25 to 5.5 at the federal funds rate. It is the highest in 22 years that it has ever been, or that has been in 22 years. The SOFR rate is the secured overnight financing rate. That's the rate that the banks trade at with each other. We're at like 5.3 there. The 10-year treasury today dropped down below 4.5. It's at 4.49 right now. 2 weeks ago, it was almost at 5. So that number right there, the 10-year treasury, if you're looking at multifamily and you want to know kind of what your rates will be, if it is a stabilized multifamily asset, in a good area, it will more than likely qualify for Freddie and Fannie debt. That is your best option on multifamily real estate. In general, that is the best option. And those rates are based on the treasuries. So a 10-year treasury rate at 4.49 will tell you kind of where your rates will be on a 10-year term loan from Freddie or Fannie. And what you're going to do when you see that 4.49 on the 10-year treasury is you're going to add anywhere from 1 3/4 to 3 points to that. So you're going to be anywhere from, I guess, 6.25 to 7.5, almost 8% in some cases on the Freddie and Fannie side. The bigger the deal, the higher the loan amount, the nicer the asset. The lower your rate's going to be. Or if you have a lot of lower income rent. Freddie and Fannie are mission driven, and they are here to provide affordable housing for as far as workforce housing. So if you have rents that are lower than the market, and we can call those affordable or mission driven rents, then you're going to get the better terms as well. So in this current market, there is going to be more and more opportunity coming up. There are a lot of people who were in bridge loans, who were in short-term situations, 5-year terms, 3-year terms through Freddie and Fannie or CMBS or whoever it was. Those terms, when those terms end, those rates become adjustable. And so their rate might be at a 3.5 or a 4.5, and now their rates are going to jump up to a 7. That is going to take most properties, and it will turn most properties into non-cash flowing. And some of them will even be upside down. So when you hear people talking about loans coming due, that's what they're talking about. When these loans come due, a lot of times these properties are no longer going to cash flow. And when the property doesn't cash flow, the ownership has to do something. And in a lot of cases, it's even worse than not cash flowing. They're cash flow negative. So the owner's pulling money out of his pocket every month to be able to pay the payments and keep the property afloat. So that is when we're going to see more opportunity as this continues to happen, and this, the things that are going on continue to unfold. So, higher rates are keeping a lot of sellers out of the market. People that maybe planned to sell last year or this year, if they don't have to sell, they're not going to sell. And then, to add to that, I read an article recently that, rents have fallen, I think $27 on average per month. Mostly in the South. They've slightly increased in the Midwest, but overall, nationwide, rents have fallen over the last couple of months by $27 on average. So that's not a good metric to look at as far as, when you're looking at the cost of ownership for these owners is getting higher, and then the average rates the rental rates are going down. That's not real good for ownership of their properties. And that just means that there's going to be some more opportunities coming up for buyers. So getting on with your main topic, what is the biggest challenge facing commercial real estate? I'm going to go through, I think I have three different things that we're going to go through on different issues or challenges that are facing commercial real estate as we speak. If we look at commercial real estate, different aspects of commercial real estate, whether it's multifamily or office or whatever it is, they're all going to have their own individual things that are really hitting them hard. Especially when you're looking at office or hotels, those are really being hit hard. Office, because of the whole COVID stuff and people now working from home, that has really hit office really badly. A lot of lenders and things have, pretty much just stopped lending on office. A lot of our lenders have. We still have options for office, but it's going to be limited in comparison to what it used to be. And then hotels are getting tougher and tougher to finance right now. We've had a lot of hotels that we've been working on, and even SBA was like the best option for hotels, like when you're talking non-flagged hotels, if they don't have a franchise name on them, and maybe they're a smaller operation, like 10 million or less, or 5 million range or less. SBA has always been kind of your best option when it comes to hotels. And we're financing a few hotels currently, and out of our 13 SBA lenders that we have in our in our pocket that we work with, I think one of them, we have one of them that said, yeah, we will look at the hotels. The rest of them said, we're not looking at hotels in the current marketplace. So those are a few things that are, you know, going on aside from multifamily, self-storage, and, mobile home parks. Those things are still kicking butt. But, hotels and office are getting tougher and tougher to do. So, when things get tough, sometimes that's when your best opportunities come as well. So, we've had hotels recently that we've looked at. People are wanting to refi. We can't help them with a refinance because they owe more than what we can refinance it for. One in particular, they would have had to pull, I think it was 4.5 million out of their pocket to be able to refi. So they would have had to put money in to be able to refi, and they're under a bridge loan, and that the rates adjust every month. And so these people are really in trouble. When you find borrowers like this, you're going to be able to get good deals and good buys on real estate. And there's a lot of them out there. And over the next year, if rates continue to stay higher for longer, which they're saying are, all these things going on, you're going to see more opportunity. So all right. So the main topic, what is the biggest issues facing commercial real estate, or the biggest challenges? And when we're talking about this, it is not meant to be negative. In this current marketplace, it is kind of a negative. It's kind of overall a negative market. When you're looking at the things going on. But as an investor, we see negative and we start seeing, well, we're going to be able to, make money on the purchase. When we buy a property right now, we should make money the day that we purchase a property. Um, and that wouldn't happen if we didn't have negative things going on in the marketplace. So the Fed has come along, and issue number one that we have to look at is interest rates. When we're looking at interest rates, when they used to be 3%, now they're 6.5 to 8%. If you have somebody that at 3.5% was paying, $150,000 a year on their debt service on a property, and their rates go adjustable, that debt service, could be, 250 to 300,000 a year in debt service. That hurts. When you're looking at 150,000 in comparison to 300,000 or 175 or 275,000, whatever the number would end up being, that's going to do a lot of things to that property and to the ownership of that property. For one, it hurts the valuations of the property. When the cash flow goes down, that hurts the valuation. When we were looking at commercial real estate is the value of commercial real estate is solely based on the cash flow. And when your interest rate doubles, that hurts the cash flow. Through this process, I talked about the loans coming due already. There's a lot of those. I don't know the numbers. I've seen a lot of different reports of a lot of different numbers of trillions of dollars and billions, hundreds of billions of that are coming due over the next year. And I'd say it's safe to say most of these people's loans, when they're coming due, they're going to be in a bad situation. And that being a negative, we as investors have to look at it as, well, what is that doing for us? And, because of the pain in the market, it's going to allow us to be able to pick up some deals. But, through this hurting valuations, it hasn't really hit the single family house market a lot. I don't think that our personal residence here that we live in, we have a lot of equity, and I don't think we've really lost any equity just because, people are staying put. They're not moving because if, like we're locked into a 4.2 interest rate, I think. You know, and if we moved, we'd be going into probably a 7.5 or 8% interest rate on another property. And everybody's in that same situation, so they're going to stay put, which is going to keep the personal residences. It's going to keep the values up there. But when we're looking at commercial real estate, these loans, most of them are 3, 5, 7, 10 years, 10-year terms, and they're going to come due. You know, for the longest time, people would take these short terms on the loans because values were climbing so hard. They're doing forced appreciation, and in 2 years' time, they're raising the value of the property by 30%, 40%, sometimes more, and then giving these big returns back to their investors. And if they would have had a 10-year term on their loan, when they go to sell that property in 2 years' time now, they're going to have big, prepayment penalties to pay. And to keep from that, they would decide, well, we're going to do a 2-year term or a 3-year term, and that would cut down the prepayment penalties when they would go to sell. So now I think a lot of people are looking at these longer term loans, and when they're buying at a 5-year term, a 10-year term, instead of the 3-year and, a 5-year, instead of, thinking longer term. Because we're wanting to drag out this, if we have a cash flowing property at 6.5% in 10 years time from now, if we still have that 6.5%, chances are it's still going to cash flow. So that's where people are looking now, and they're not looking at the the quick dollar that we were getting, before the Fed started raising rates. So so what is the biggest issue facing commercial real estate? Issue number 2, and this is why we're having issue number 1, is inflation. And inflation can be good for real estate investors, but it can also be a negative. And we see the negative in, that the Fed is coming out and putting the brakes on it all right now and saying, hey, we need to slow down. And they're hurting the economy. They say for the greater good or whatever it is. But, whether you agree with what they're doing or whether you don't agree, it's still happening. It's still happening. They're still, hurting valuations. They're raising the rates, all these things. But we'll talk a little bit about inflation and how it's good for real estate, and we'll talk about how it's bad for real estate as well on the next page. So the good, when we're talking, what is the good on inflation when we're talking real estate? But let's talk about the bad first. We'll leave the good for next. The bad, the cost to run the property goes up. Anytime you call a service technician to do anything or anything you do, it's going to cost more, which hits the expense column of the property, whether it's payroll, everyday expenses like lawn care. Those things are all going up as mowers cost more, payroll costs more for the landscaping companies, and on and on and on. All those expenses are going up because of inflation. Insurance has gone up like crazy. We know a borrower in Florida that has had, their insurance rates, I think he said 2 years ago, they were in the 700s per door. And this is somebody that's got several thousand units in Florida. And their last quote they got on insurance was over $2,000 a door. You can blame the hurricanes and stuff like that, but when the contractor's cost of doing projects and restoration work is, double or triple what it used to be, that insurance cost is going to go up. Some states, taxes are really hurting people. We've lost a few deals here in the last 6 months in Texas because we were, going into the deal, everything's looking good. They were slow getting tax numbers back. So we were estimating, the lender and the underwriters were estimating what the taxes were going to be, this and that. When we got taxes back, we had one occasion where it was $60,000 more per year in taxes than what we had expected on the income sheets, and on the T12s and things, and that killed the deal. The deal didn't close. It went back on the market. This is the effect that the Fed has had on the Fed has put brakes on the market because of all these costs going up, whether it's groceries, cars, whatever it is. So the good, when we're talking inflation, rents go up. So that's a good thing for real estate owners, and landlords. Rents go up, and when the rents go up, values go up. Real estate ownership is probably, some people say gold, all these different things. I think personally, real estate ownership is probably the best hedge against inflation that you can have. And if you agree with that, throw a 1 in the chat and say, yeah, Jerry, you're right. Go ahead and throw that in the chat, and let us know what you think. So now our next page here is issue number 3, and this is the final issue. And if you are a real estate syndicator and you're going to be raising money for deals, I think that this here could be the biggest issue that we are facing as we go into next year and we go into the year after. And that is issue number 3 is the media and bad news. So commercial real estate, I've already started seeing news stories. If you've got your ear to the ground and you're listening and trying to see what's going to happen and what's going on, or if you watch the news, I don't watch the news because I believe the news. I watch the news just to hear what they're saying to us, because you got to kind of know what's going to happen around us. So I watch them for that, not for them to tell me what, and to listen and hear what they're trying to pound into my head, but to say, hey, this is what they're going to be doing in the future, because they're saying this or that. So, when I say the media, I definitely am not somebody that believes anything any of them that tell us, but I'll get off of that. But there will be negative stories. There already has been negative stories coming into the market. When we're looking at, I was talking about that hotel a minute ago. They owe $8.5 million on it's a big flagged hotel next to an airport, a big city airport. And they owe $8.5 million to a bridge lender. I think their rate right now is at like 13% is what they have to pay to this bridge lender. And next year, when this year's over, it's going to add a point to it. On top of, they have a spread over top of SOFR or something for their rate. And then each year that spread gets bigger because that lender wants to get out of the deal. So for them, think about this like this for a second. For them to owe $8.5 million on a bridge loan, they more than likely bought this hotel for $12 to $14 million. That, difference between the 8.5 or the 12, let's say, that's, $3.5 million there that they probably raised, from equity partners or LPs. Well, what's going to happen to that hotel is they're going to end up having to sell that hotel. And if they're lucky, they're going to be able to sell it for that $8.5 million that they owe on it to the lender. Because the next guy that's coming in is going to be able to borrow somewhere between 4.5 and 5 million on that property. So that difference right there, all that money's going to the lender. Okay, if they can sell it for 8.5 million, all that money's going to the lender, and the people that put that $3.5 million in, or that 4 or 5 million, whatever it was that they had to come up with for that purchase, the LPs, that money's going to disappear. And most of the syndicators are going to people and they're raising money, you know, and they're raising 100,000 at a time or 500,000 at a time, sometimes $1 million. But when these stories start coming and hitting the market of, you know, maybe it's an older person or a grandma or an aunt or uncle that, you know,
It won't feel good.
I'm sorry.
So it's already started. Actually, it's already started. A lot of LPs and even private money lenders are already backed out.
Yeah.
You know, yeah,
Yep.
it's already happening. Yeah.
It's happening as we speak. When these negative stories, we're going to start seeing more of these stories about these things hitting the media.
Yep.
Okay.
Yep.
And that is going to make it a lot harder to raise money for deals.
Yeah.
When every time somebody clicks onto Yahoo News or AOL News or whatever it is, and they see CNN, they have big news stories about groups of people that have lost, you know, $1 million, $2 million, you know, their life savings is gone because of real estate deals. It's going to get really tough to raise money for deals.
So there is
I
another
think,
news I heard from one of the PML, private money lender. He invested, I mean, he lent it like 7 million in 2020 for a 5-year balloon with like a lower 3 interest rate. And this guy was able to grab a second position after rising the ratio, that ratio. So with another 1.5 million. But now rents are going down and unable to pay. So basically all the LPs and even the lender will lose money. So they'll have to sell it for like lower 5 now.
yeah, yep. There's Exhibit A on what I was just talking about. So there's going to be a lot of these stories hitting the news media. And that's why I'm saying the media and the things that are going to be hitting the news cycle are going to be the biggest issue that's facing commercial real estate and commercial real estate investors. People who are sophisticated investors and are looking at the market and know what the market cycle is doing and all these things are going to see it, and they're going to see opportunity. But your average investor is not that.
Yeah. So follow-up question on that. Like, you know, so there is a lot of this type of deals there in the market. Like, you know, this bank owned one. So where do we find? I mean, I hear that a lot of guys are like, you know, disposing the position. Bank is taking over because of the ratio is much lower. So, but apparently don't see any deal as well. Like in a lot of these deals coming in extremely higher price. I mean,
Yeah.
is it? Yeah. I mean, how do we find, you know, like such deals?
Well, as there gets to be more of them right now, the deals that are hitting the market, when you know a lender has a deal that they foreclose on, they already have, you know, a book of 20 other borrowers that they know that are there, and they're going to start calling their current borrowers that are doing good on their properties. They're going to start calling these guys and saying, "Hey, I've got a property here I really need to get rid of." And they're going to start selling them off to the people they know first. On some occasions, you know, they might go to auction. It's different in you know, depending on who the lender is, it's going to be handled in different ways. But I would say continue building relationships with brokers. Continue building those relationships. The first and the nicest properties as they come up on the market, those are going to go to people that have closed deals. Those are going to go to people that they know can run deals, and they're going to turn around and let these people take the deals because, you know, they want somebody that can run the deal and that they trust. The thing that I think you can do now is realize, you know, I'm part of Grant Cardone's Real Estate Club, and every Wednesday we do a call at noon every Wednesday, and on that call, people bring their deals and present the deals to the group. The first question that Grant asks them every week on every one of them is, why are they selling? So why are they selling? it's going to tell you whether they are a real seller or whether they're just somebody testing the market or whatever. So if they're a real seller, the answer is going to be, they have a loan that just came due, or their loan is coming due in 5 months. So these people that own properties right now know that their loans are coming due. They know that date. And a lot of these properties that are for sale right now have that date, and they know that date is coming. So hitting it before the foreclosure process and saying, hey, I'm willing to do this, let's do this. And then you take the property, and yeah, I mean, some of them are going to be real stubborn, and they're going to hold on until the LPs lose every dime, because it's a pride thing. They think, oh, well, next week it might drop. Next week we might be able to get out of it. Next week, and they keep holding on. People who are smart right now, if they have 5 months left on their term before it really starts getting, more and more properties on the market and things, they're going to start selling now, and they're going to take a little bit of a loss instead of, if you have an LP that invested 100 grand with you and you can give them 50,000 back now or nothing back next year, which one would they rather have? So the sellers, I think the smart sellers are going to start coming to that realization of, hey, my lending partners, we need to have a talk. You guys know the marketplace. You know what's going on. This is the situation we're in. This is as much as we're going to get. I'm going to get as much as I can. And maybe the owner doesn't take his cut of the 20 or 30% or whatever, and he gives it all back to the LPs or whatever. But, I think the best opportunity is just right now getting in the marketplace, starting to make offers, and trying to take these before they go into foreclosure. So in conclusion, it is always a good time to buy cash flowing real estate. These problems in the market, even if they're going to drag on for several years, in the market as a whole, they are short-term problems. If you look at real estate, I saw a little video the other day, and it was an old news story of, and they were in San Diego, California. I think it was the early 80s. And they're in San Diego. And if you know San Diego, you know that real estate is really expensive in San Diego. I mean, your average, 3-bed, 1-bath house could be $1 million or more. They're on this news story talking about housing prices in the early 80s and how they've gotten ridiculous in San Diego. And they're talking and showing a house, and they're saying, and this home just sold for $78,000. Well, look, now, I mean, we're 40 years later, and $78,000 isn't even a down payment for that house. So when we're looking at the real estate market as a whole, if this drags on for a couple years and the rates stay high and the things continue to happen the way they are, this is still just a short-term problem. Real estate will come back. It always does. And as Grant Cardone always says, don't wait to buy real estate. Buy real estate and wait. And I heard my grandmother, she's still alive. We just had her birthday, 86th birthday the other day. She was telling me, it wasn't this last time I saw her that she was telling me, but she had told me, a couple of years ago about her and my grandfather. They lived in Monterey, California, and they bought a house in Monterey, California. It was a brand new build. And I think it was in the 50s, 54, 55, something like that. They bought this house, Monterey, California, several miles, just a couple miles from the beach. Really nice new development. And she said that we paid $8,000 for that house. And, $8,000. And now, I don't know that area real well, but I'm guessing if you could possibly put a 2 in front of that 8, and it'd be a $2.8 million house now. There's a good chance of that. So that's what real estate has done over the years, and it's going to continue to do that over the long term. We could have a time here in the future if they decide to drop rates, which there's a good chance they could drop rates right before the election for, election purposes or whatever, both sides play those games. But they could drop rates. And I've heard different analysts and things saying if they drop rates, 2 points, that it will put us into ultra, and like, I forget the words they use, but an ultra inflationary period where, your $500,000 house is now going to go to $1.5 million within a year, and then 2 million in the next 2 years, and it's, so these things could happen. But if you're not a real estate owner, that doesn't happen for you. If you own a single family house and it goes up from 500,000 to 2 million, inflation didn't hurt you that much. I mean, you're going to be hurting otherwise probably, but you've got all this equity now in your home. If you own an apartment building and your per unit cost was 100 grand, and we hit that ultra inflation, and now your per unit cost or your price would be 300,000 a door, that's good, as far as an owner. So inflation can be good for property owners. But like I said, this is a short term thing. Even if it lasts 5 years, it's still short term over the long haul. So I'm going to open it up now for some questions. If anybody has any questions.
There's one in the chat that I want to read to you.
Go ahead.
Do you refinance the SCR loans? And if so, what are the typical criteria considering next year if the rates drop?
Yeah, I mean, as far as, it depends on what you're looking at. I mean, if you're worried about refinancing now and then next year the rate's going down further and you're worried about prepayment penalties, we can pay down some of the prepayment penalties at closing on a refi. Or, I've seen people here recently have come to me, and we're doing some that are actually, we're doing a 2-year bridge loan. We'll refinance it into a bridge that's like an interest only loan. And then in 2 years, we just refinance that, or even in a year, we refinance it. It's got like required to pay 1 year's interest. And then after that, there's no prepayments on those loans. So there's a lot of different things we could do. Our criteria is the same as a lot of people, 620 or better credit score, property's got a cash flow. It's got to be in a good area as far as population. We can't lend in rural areas too often. It needs to be a metropolitan area or within 20 miles of it. So I think it's 20,000 or more population. So, but yeah, reach out to us. I'll put our contact info up here before we're done, and reach out to us about it. We'd love to help. So Kyle, how's it going, man?
He said,
Good,
thank you.
good, thanks.
Good to see you, man.
Yeah, good to see you guys too. I have a question. So I am looking at a 6-unit here in Ohio. I was just curious what kind of options I have. So it's at 750 purchase price, 750K. Just curious what kind of options I would have for debt.
Yeah, when you're looking at those smaller deals like that, I mean, we can make them work. You're not going to get like where we talk about, 6.5 to 7.5%, like with, Fannie and Freddie. We can't do that with Fannie and Freddie. Fannie and Freddie, your minimum is going to be like $1 million to $1.5 million on loan amount. We have plenty of private lenders that will fund those things. The same lenders that fund the DSCR loans, when you're talking about the single family rentals and things, we have some of those that'll fund up to 20 units, below $2 million. And, we can fund those depending on how the DSCR works out on them. We can go up to 75% of the purchase. You'll be anywhere from, 8 to 9.5% usually on those as far as interest rate and things.
Gotcha. Yeah, that's kind of what I expected, but
yeah.
Thanks for
send it over and I can always give you a quote on it. So
okay. Sounds good.
Yeah, for sure.
Yeah, guys, if you have any questions, raise your hand, or you can put it in the chat and I'll read it out. There's one in the chat.
Yeah, go ahead.
What is the outlook on multifamily rents, and what is the outlook on hotels?
That's kind of a loaded question. As far as rents, the Fed could put us into a recession. I mean, depending on what you call a recession, if you're going by old definitions, new definitions, whatever, we could be in a recession now. We could have been in one a few months ago. We might not be. We might not ever hit one. Who knows? The job numbers this last, everybody got excited because the job numbers were down. And the job numbers being down this past Friday, I think it was, them being lower than expected, is a big reason why, treasury rates and things have gone down. And so when we see these, when we're looking and everybody's getting excited about job numbers going down, we hear companies laying off, we're hearing all these things. It's going to be really difficult for property owners to raise rents when people are struggling to get work. A lot of people, when we're looking at people that are living in apartments, and most apartment communities, it's your workforce housing. It's people that are, that are keeping the lights running in the country here. They're the ones going to work every day and putting in the 8 hours, and the ones that are, struggling to make ends meet, they're putting in 12 and 16-hour days. And when some people are getting laid off, those guys putting the 12-hour days in are going to be real happy to get 8-hour days, right? And so it's going to be getting more difficult to raise rents on people that are struggling financially. So I kind of see rents kind of leveling out for a little while. People add, that 3% a year in their pro formas when they're looking at, properties and underwriting properties. The lenders really aren't giving them credit for, 3% a year right now when they're looking at pro formas and things on deals. So I don't see them I don't see a point here in the next year where we can look and say, hey, rents are going to start bouncing up unless interest rates come back down and the market just goes crazy again.
So we have specials in most apartments. That's what I see. Like a first month free, second month free, or there are a lot of specials going in pretty much all markets now.
Yeah, nationwide it's going that way because they're just trying to keep things. They're trying, when the market slows down and people are struggling for work and struggling for money. If you have a single guy and he has a single buddy, and they're both struggling to make rent, I mean, what's keeping them from living in the same place?
Yeah.
And that cuts that landlord's money down in half. And it's even more popular with ladies to move in together to split bills, even if people moving in with family members and maybe opening their basement up to a brother or a sister or a cousin or something, just to make ends meet. That kind of stuff will continue happening, and it'll be I think it's still going to be, I think if you have a nice property, nice location, it's in good shape, you're going to be able to rent the property. But the time where you could move somebody out and then that was paying $1,000 a month and move somebody new in and charge them $1,200, I don't know that those days are here anymore. And they'll come back eventually. Like I said, we're in a short-term period here where it's going to be like this. It's going to be stagnant for a little while. So.
Yeah, Jerry, those are concessions. I mean, so, in a market like that, you it's kind of like, having something better than nothing, right? Getting people in, and you put that on your your P&L, right? You got to track that over time, and hopefully what you do in turnovers, you kind of work out of the concessions and get your income back up. So yeah, that's a strategy, but you want to use that when you're really like, having struggles like this, just to get the property leased up. So yeah.
Right. Yeah. And keeping at least, when if you have a big employer in the area or something that has laid off. My oldest son works for Facebook, and they've had 3 layoffs this past year. He's made it through all of them and not been laid off, but I think one of them was 2,000 people, 11,000 people, and I mean, these are a lot of people leaving a lot of them are going to get another work, but that hurts everybody when, it hurts the grocery stores. It hurts Lowe's and Home Depot. It hurts everybody when people are being laid off, so.
Yep. So there's another question.
Yeah.
First question that Grant asked, why is the seller selling? One of our deals, the seller is selling is because his loan is coming due. If he's not able to refinance, how can a new buyer make the deal work?
Well, I was talking about that hotel that we were working on and trying to help a borrower out on it, an owner out. They owe $8.5 million. They are needing to finance $8.5 million. They need to pay off that loan of $8.5 million. They probably paid $12 to $13 million for the property when they originally bought it. At this point, we looked at it. We were able to refinance them. I think it was like one of the options was like 4.75 million is what we were able to refinance them for, and that was like the most proceeds we could get them. And all of that is just because it's not because their income is down, it's because the cost of debt is so much higher now than it was. So somebody can come in and offer 8.5 million, or talk to the lender and say, hey, I've got an offer on this property for 8 million or 7.5 million. And that lender might say, go ahead and sell it. This is the best we're going to be able to do. We'll take that loss. And, that new buyer coming in is going to be able to get debt at like 4.7 million. And then they have to come up with the difference. If they're buying it for 7.5, they're going to have to come up with that difference between the 4.7 and 7.5 million. And so that's how you're going to be able to buy it, is you're buying at a lower cost basis. When you're looking at the price of the property, you're not able to borrow as much. And, the people that are selling are just going to lose. And that's the market that we're in. So that's how it works.
And someone made a comment. There's so much true about job loss and people not spending as much, and then increased rents being expected in pro forma projection. Pro forma numbers are at such a risk right now, being there are more layoffs happening.
Yeah. Yep. Well, we own a construction company as well. We've been in the commercial roofing business for 20 years. It went on for several years where I was getting, 5 to 10 new projects in my email inbox every week. 5 to 10 new projects where they were, hey, can you bid this project? We need a roofing contractor, because we do mostly new construction, commercial new construction. And it was, we need a roofer. We're building an apartment complex. We need a roofer. We're building a new city building here in this township, whatever it is. This past month, we maybe had 1 or 2 in the past 30 days of invitations to bid projects. And that's been that way for about the past year. When the interest rates kicked up, planning for new construction projects just died out. The cost for new construction, it didn't make sense to build new construction anymore, because the rates had gone up so much, and it was going to cost so much to do this new construction. And then on top of that, as the prices of property and the valuations are going down, inflation's gone up, and contractors are charging more, materials are more, all these things have happened. And new construction is the projects you're seeing being built right now. They broke ground 2 years ago, a lot of them. The planning started 2 years ago, 3 years ago, 4 years ago. When those projects finish up, all the people that are working on these projects are going to be out of work. There's not new work to replace it right now. So these things are all happening at the same time that apartment owners and all these people are hurting. My brother-in-law is part owners of a flooring business, and I think they run like 15 crews. in their flooring company. And their flooring company now is, I was talking to him today. We coach a basketball team together. And I was talking to him today, and they're taking on projects. They have their flooring guys out doing roofing projects right now because they're scared that there's not going to be work here in the next year. And they're taking on all kinds of different projects. And so people are going to, do what they got to do to make money, but there's going to be a lot of people out of work here over the next 6 months or so. So, and it's going to hurt. It's going to hurt property owners as those things are happening as well. And it's going to drive prices and costs down to buy new apartments down. So people that are able to raise money, people that are able to build the relationships with the brokers and to get in and get the deals done are going to really benefit from this market. So what time is it? That's after 9.
One quick question. So even this days, the gap funding is still possible, or any loan we'll have to bring like 20 to 25 or even 30 years down?
Oh, percentage down. I mean,
yeah.
The biggest thing I have seen right now, I mean, when we're looking at Freddie and Fannie debt, we can lend up to 80% of these loans if the DSCR works out.
Okay.
So I'm still seeing most of them that come across being 65% loan to value, at the most 70% loan to value, because of the way the DSCR is working out. We have to hit that 1.25 to 1.35 DSCR to make the deals work. And so that increases, most cases increases the money that you have to bring to the table to close.
So in that case, is the gap funding is still possible, or that's not an option anymore?
Oh, you're looking like, part of the equity being funded?
Yeah.
Yeah, that's a possibility. Generally on bigger deals, there's not a lot of options. I mean, there's some guys out there that do it. But you got to remember, these guys that are funding these, they call them gap loans or mezzanine debt. When you look at these people are putting this money out on these gap loans or these mezzanine loans. The people that did that 2 years ago along with a bridge loan, that the bridge loan is now due, that money no longer exists now. It's vanished overnight. As the interest rates climbed, the people that had equity in these deals, that equity's not there. So if the deal has to sell, that equity's gone. So there's fewer and fewer every day of people that have money to put into these deals as far as equity positions, and especially when you're looking at the private lenders that used to do these things. So there's fewer and fewer of them all the time.
Got it. So yeah, got it. Okay. So so this gap funding, like any a percentage cut, like 10% has to bring, or like 15% you have to bring, something like that, or?
Yeah, each lender has their own. I mean, they want you to have some skin in the game. So if
Okay.
you're getting a 75% loan to value or 70%, they're going to require you to have 15%, in the deal. So
okay. So when you say loan to value, is that's a purchase price, or that's a price value?
it would be on the purchase price. Yeah, that's what you're going to value it at generally.
Okay.
Yeah.
Okay.
Yep. So good, Kyle.
Hey, just a quick question on, so I've been underwriting to like a 2% rent increase, but after hearing you guys, I kind of like, man, that might be a little bit too aggressive, especially with like a 5-year hold. So what are your thoughts on that?
Yeah, I mean, who knows what's going to happen in the next 5 years? I mean, we could get to a point where you can figure 5%, 2 years from now or 3 years from now. But
Mm-hmm.
I mean, whatever we lose here as far as increases go, we'll pick back up here in the next 10 years probably. So at some point in the next 10 years, we'll probably pick those back up. So
Yeah, might be good just to plan for a longer hold.
yeah.
So,
And if you buy property that's cash flowing, you've got long-term debt. If you buy it in a good location, where there's lots of jobs around. You can't go wrong.
Got it. Yeah, thanks for that.
For sure.
So most Midwest, rents are like kind of okay, because those rents are not raised like 20% like New York, Chicago, or like San Francisco. Like the rents are like 20% already went up from COVID, post prior COVID to now. So those markets will readjust it. I mean, that's what I'm thinking. But the other markets like Iowa, Columbus, those markets still have a potential opportunity to go a little bit higher.
Yeah, for sure.
That's my gut feeling. Yeah.
Yeah. If you look worldwide, America still has the lowest rents worldwide. Like if you're looking at Europe, you're looking at Australia, these different places, the US has such a low cost of living in comparison. Rents are going to go up, and they're going to meet those other places eventually. So, Grant's talking all the time about, look at what is going on in California. That he said Florida's the next California. And he said California is going to be like Europe eventually, and New York and these places are going to be like Europe, and Florida's going to follow behind them. And then it's all going to flood the Midwest as well. I mean, it could be a 20, 30-year process, but that's what's going to happen over time. So things that I need for a quote, if you need me to get you a quote and you're looking at multifamily, T12, which is your profit and loss statement, rent roll, and OM is very helpful. Summary of what you plan to do with the property or your pro forma. And we will eventually need SREO, PFS from your sponsor, or if you're the sponsor, just send that in with it as well. So we're running out of time. We're over time, so I'll go ahead and go through these quickly. What can you do today? So not everybody, I think most people on the call eventually want to be able and be in shape to be a KP on deals, to be able to co-sign on the loans, right? What can you do today to get that process started? First, work on your personal financial statement and your SREO. Get your bio together. Make sure your personal credit is in order. And then also work on raising capital. Start talking to people and telling them about the education you're doing and this and that. Tell them about those things. Or figure out ways to make more money. And we have a great way for you to be able to earn extra money for almost doing nothing. And that is through our referral program. We pay referral fees out to people that bring business to us. And all we require for that is an introduction to your customer, or or not your customer, it would be our customer, but it would be your contact, just to introduce us, allow us to help them with the loan process, and we will kick you back a fee. We will be going over that next week, right? Next Thursday, we've got one scheduled. Is that right? And what is that date?
Yes, on the 16th.
The 16th, that's next Thursday. We will be having a referral program Zoom. It will last about 30 minutes. We'll go through it real quick about the program.
If you have any questions, you can get it answered there.
Yep. Any questions about that, show up on that call and we'll help you with it. Yep. This week's verse, Proverbs 1:7, the fear of the Lord is the beginning of knowledge, and fools despise wisdom and instruction. So, and we all know people that despise wisdom and instruction, and so that verse is fitting for a lot of us, I know. So, next Zoom call would be our next Zoom for our debt Zoom is going to be canceled because of the Thanksgiving holiday.
Yeah, I was debating on whether we should have that or not, but then it's the day right before Thanksgiving, so I canceled it.
That sounds good.
But happy Thanksgiving, early Thanksgiving.
Thanksgiving, everyone. We will be doing
Jerry loves Thanksgiving.
Oh yeah. So we'll
and
be
November
doing, go ahead, sorry.
November 16th is when we will be having our referral program, which is next week. It's a Thursday. Join. It's at 8 o'clock. We'll talk for about 20 minutes, maybe less than that, and then you guys can get your questions answered. And then December 6th will be our next call at 8 p.m. How to grow your real estate portfolio in 2024.
Yeah,
Great time.
I'm excited about that one. Here is our contact info one more time. And
you can just scan that little thing right there and you'll get all of Jerry's information.
Yep. And join these calls, guys. I'm not going to go through them all again because we are over time. But join these calls, become a part of the community, let people know who you are. And you guys have a great Thanksgiving.
We appreciate.
Yeah.
Thank you. Bye-bye.
We appreciate each and every one of you joining us as always. Welcome to the new guys. Hope you guys join more.
Yeah, for sure. And everything you do it with Thanksgiving. If you treat your job, your regular job, if you have a W-2 job, if you treat it like you're thankful for it, you will do your job better. If you treat the opportunity to buy real estate with Thanksgiving, you will definitely do that better as well and be thankful for everything. If you treat your spouse like you are thankful for them, your life will be better. So everything you do it with Thanksgiving. So God bless everybody and have a great holiday. And I'll probably see some of you on calls next week. So.
Yeah. Thank you for joining, guys. I will leave you with some music. Have a wonderful weekend. Hey, guys.
When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. Rule one, getting money, never losing no. But I'm broke, but now I'm living at it. They just count my zeros and some decimals. And I wish you would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico, I invested though when I let it grow. Pentiments I got a pocket full. Rich the income and your taxes low. Spend it right and then invest some more. And if you don't believe me, ask my doctor down. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the checks. I buy apartments, I send checks. Yo, billionaire went undercover, help y'all discover who did it best. Just bought 2 choppers, can't wait till they see the face and they see what I do next. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow.
Yeah, and only then do I buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heels are?